Well, thank you everyone for joining our first AIE Melbourne webinar today. Firstly, I'd like to show my respect and acknowledge the traditional custodians of the land of elders past and present on which this virtual meeting takes place. Joe Delaney and I will be co-chairing the webinar today, and we are very excited to be joined by a special guest and renowned speaker, Tim Buckley, Director of Energy Finance Studies Australia and South Asia at the Institute of Energy Economics and Financial Analysis, IEEFA, who will share his perspective on the opportunities and risks at this pivotal moment in the energy transition as the renewable energy and storage sectors continue to achieve global record-breaking milestones. With over 30 years financial markets experience now providing public interest-related financial analysis in the seaborne coal and electricity sector for IEEFA, Tim is studying energy efficiency and renewables across China, Japan, and India, global capital flows and resulting stranded assets risks in Australia. So we are very excited to hear from Tim today. But before we hear from Tim, I'll pass on to our AIE Melbourne Chair, Kerem Levy.
Hi. Thank you, Stephanie. I'm quite happy to be here today, or where we are online, and this is the first event online for the Melbourne branch, so we're quite excited. I won't speak long. I'll just say a few words about the AIE, the AIE in general, and then a few my 2 cents worth on the topic. So for those of you that don't know the AIE, it's a volunteer organization with the banner of leadership in energy. So it means supporting leadership on all levels. This is not just executive, this is basically everybody in the energy sector who is keen to understand more. The underlying mission, I used to say networking and knowledge sharing. I think we can simplify today, say it's all about learning and talking. We've been operating since 1977, so we're already quite a history behind us and a lot of transitions that have happened. The organization has been there. We have about 1,400 members nationwide. We are technology neutral, so we're not the Clean Energy Council, but we are always trying to see what are the best solutions for the market, for the energy grid, and for people in there. As an organization, I'd say our activity is very relevant to anyone with interest in energy. One of the interesting points I was thinking about, this is basically the first or second event of the year, and when we think about the changes, if you think about where we were a year ago and what discussions were kind of almost linear. Everybody had their approach of where we should be heading to in terms of decarbonization targets and targets for renewables, and come COVID-19, and I think it really shuffled the deck. To a point where a lot of people now looking more into, okay, well, changes, how do we do, what is it, what is the trajectory of different things, starting with COVID-19, but it also highlighted the importance of the global effort and global learnings and interdependency between countries and what we do and how we can really learn from anything. I think COVID-19 is a very good example of looking at what other countries are doing and seeing what we can adopt and what maybe we should not adopt. And it's really the rate of change. I was looking for a graph that talks about the rate of change, and I think it's gone faster now. Like everything that we were thinking is now quicker, the opportunity is sooner, or it's even a necessary element. How do we restart the parts of the economy? And from a lot of people talk about renewables as a great option to accelerate the transition, we increase investments, and so on. So I'll just, as a humoristic meme, so I need to quote this point about algebra classes and exponential functions and so on. So the key point is about change. And within that, that's one reason we're very happy to have Tim and can share with us his insights about what's going on in the world and in Australia. In terms of one of the additional benefits of the situation is that because we've gone online, it means that it's much easier to share content nationally. So I've put up the upcoming events. You can see from Perth, Newcastle, and Sydney. This is online events, webinars such as this one, but it means it's organized by them. And I think if you look at the content is relevant for everyone. So as my finishing statement, just want to invite people to have a look at the dates and see if you can join in. And generally, if you are interested in being active and consider joining us, we are more than welcoming everyone. Thank you. And Stephanie, back to you.
Thank you, Kedem. I might hand it over now to Tim to basically take us through his presentation. We are very keen to make sure that this is an interactive session. So please put your questions in the Q&A section, and Joe and I will coordinate and make sure we'll do our best that all the questions get answered, and if we don't, we'll make sure that at least we have a good discussion with Tim at our session today. Over to you, Tim.
Right. Thank you, Stephanie. Kedem, has my screen share come up yet?
Yes.
Great. No, it's not on my computer, but hopefully it'll pop up in a sec. So firstly, while it's coming up on my screen, I'll just mention that IEEFA is a public interest think tank. We focus on the energy, finance, technology nexus. We have no paid mandates and hence no conflicts of interest. I mentioned that particularly given my background in finance. I think it's important to be transparent. We're funded by philanthropy and we work on public interest issues in the energy area, and we bring a finance perspective to it. So while Stephanie's doing that, what I was going to do was talk to four main topics. Firstly, renewable energy momentum and deflation, and then talk about the financial markets and the fact that an increasing number of financial institutions are putting in formal coal exit policies. What we thought we might do is then stop after that section, open up for a few questions. So it's just not me presenting, death by PowerPoint. And then we'd move on to the global equity markets response, and then Australian context, and then open up again for questions. So four main areas of focus, and perfect, thanks Stephanie. So I've put in some details on the thermal coal markets in the appendix, so we can address that at the end. So if we go to the next slide, that one, I'll start with a topic and a slide that I've been talking to for 8 years now since I first joined IEEFA, and that is deflation. Deflation is the fundamental aspect of why I think this technology disruption is inevitable. It is absolutely being driven by an annual decline in prices of wind, in solar, and now more recently batteries and electric vehicles. And so we are constantly getting lower prices in these key new technologies, and that's driven by technology development and also scale. And the scale of manufacturing, the learning by doing, is very much an ongoing process. So I start with that in almost every presentation. I've stolen a Bloomberg New Energy Finance slide here just to show the magnitude of the deflation. And maybe just to give one data point on that, we saw in April a 1.5 gigawatt solar tender and in Abu Dhabi, and it came in at $13.50 per megawatt hour. Now, that was down 15% on the price that was tendered in a similar contract in a similar location only 4 months earlier than that. And so we are seeing constant price reductions on a like-for-like basis. And so, thanks, Stephanie. If we go to the next slide. Again, I thought this was an interesting analysis to highlight, and I've put in references to all of the documents and the charts that I've presenting today, so you can go to the original author's material. I'm not pretending it's my material. I will talk to it and you can reference those articles in detail. So RASM has put up a very, very interesting analysis showing that for the last 10 years, the International Energy Agency, and in fact, almost all forecasters, have massively underestimated the rate of solar deflation. And then RASM, like myself, comes to the same conclusion that we've been underestimating it, and the IEA has consistently underestimated technology improvements and technology deflation but we are continuing to make the same mistake even today. So RASM highlights that you have dramatic reductions likely in solar over the next 10, 20 years. And the IEA's forecasts, you could argue, are conservative, but conservative means they're also likely to be wrong or proven to be wrong again. And therefore, when we talk about scenario planning, if we're constantly referencing the IEA central scenario, we're referencing a world that has a 3-degree global rise in temperatures, and that's going to have huge implications. If we talk about the SDS, or the Sustainable Development Scenario, again, maybe the challenge is actually a lot harder according to the IEA than reality, because to what I've seen in the last 8 years, the momentum in technology development has surprised everyone. And I think that's probably the #1 point I wanted to make today. The momentum is surprising everyone, and it's continuing to happen. So when we look back 5 years from now, we'll see solar costs dramatically lower than where they are today on average globally. We'll see battery prices dramatically lower, and that changes everything. So go to the next slide, please. Thank you. The other point, Kedem mentioned that change is very much central to what's happening globally. And the IEA about a month ago said, oh, maybe the pandemic, the global pandemic, will slow the rate of change and slow the deployment of renewable energy. And I just wanted to make a key theme of my presentation that that's highly unlikely. And in fact, the evidence is exactly the opposite. We have had a global systemic shock, and there are dramatic and profound changes going on, one of which is that to deal with this pandemic, we've had to accept the science and deal with the science. Now, climate change is all about, in my view, accepting that the climate scientists are right and accepting that we need to deal with it. And so I don't think we will go back to normal. We will go to hopefully a different and better perspective. Maybe we'll be led like Germany and Korea with green stimuluses in terms of the economic investments in industries of the future rather than trying to prop up industries of the past. So again, the detail on these slides might be a bit hard to see, but the key point I wanted to make was solar module prices globally in May were down 20% year on year. 20%. 20% is not a gradual change. That's a dramatic, profound change, particularly when it comes on the back of 10 years of 10% or more deflation in the prior 10 years. So this chart from GTM on the bottom right shows the price curve, but if you look at it, it was set in December last year. And in fact, rather than solar prices being flat in 2020, they've dropped 20%. So yet again, a chart done by an expert. GTM is a major reviewer and a media group focused and analysing the rate of change in the markets, and yet their chart of only 6 months ago is already out of date. And that's the order of magnitude we're talking about. It's not a dig at GTM. I think any analyst putting out a forecast invariably is going to be proven wrong more times than not. And I know that. I've been an analyst for 30 years. But that's the key point. We're in the middle of a technology-driven disruption, and the disruption's happening faster. Thanks, Stephanie. Now, Gautam Adani, I'd normally have done a lot of work on other aspects of Gautam Adani's growing empire, but this op-ed that's on LinkedIn from last weekend, I think is profound. And it really, for a man who's probably the most powerful corporate businessman in India, he's come out with a number of commentaries in the last couple of months. This one talks about how in the last 40 years, solar prices have dropped 99%. And he then goes on to say that in the following 40 years, solar prices will again drop another 99%. And I entirely agree with him. So in India's perspective in particular, he says in the short term, we need renewables to work hand in hand with fossil fuel industry, but in the long term, it's decidedly in the favor of renewables. Now, that's in India where they need more energy across the board, so they need all the solutions. In a market like Australia where energy demand is not growing, whenever you build more renewables, you displace immediately fossil fuels. And so the faster you change, the more displacement you get, the more stranded assets you get. And I'll come back to that in a minute. Thanks, Stephanie. Another chart talking about momentum. This is a chart showing the blue is offshore wind investment in Europe, and the black is the decline in oil and gas spending in Europe. So it's only Europe, it's not China, it's not India, it's not global, it's just Europe. But what this highlights is that offshore wind investments are actually accelerating. And they're accelerating this year and next year. And they'll in fact overtake oil and gas by 2021 in Europe. Now, I mentioned offshore wind. In Australia, we don't have any offshore wind. We're proposing some offshore wind down in Star of the South in Victoria. That's an interesting development. It's a relatively, well, it's a totally new business in Australia. And what we've learned in places like Taiwan and Japan is that offshore wind has very high establishment costs. So there are costs of getting established. Europe has spent a decade investing in offshore wind. It is now commercially competitive without subsidies, and it is booming, and it's squeezing out other sources of generation like oil and gas. So it's not just about coal being squeezed out, it's then replacing other fossil fuels. So what's happened in Europe is a portent of what's going to happen in Asia. And yesterday I was on a call in Japan. Baker McKenzie was talking about the massive development of offshore wind in Japan. It's a massive development in Taiwan. Korea is looking at it, Vietnam, even India. So America is also. So it's a whole new sector of growth in the renewable area. My question in Australia is, well, the price premium to onshore wind or solar is pretty significant. So you've got to get a whole lot of other value drivers for offshore wind in Australia. As usual, Australia is blessed with a range of natural resources. And so we've got to choose the most cost competitive one. Thanks. Again, I've lifted this from Bloomberg New Energy, from Renew Economy yesterday. You can read the entire article, but it was a review presented by Bloomberg in Norway, and it highlighted the dramatic change in electric vehicles. And so while I primarily focus on the electricity market, we do have a global technology-driven disruption of both the power markets and the transport markets, and there is a massive degree of convergence in those. And so when Prime Minister Modi in India talks about electrification, he's talking about electrification in order to get off oil imports into India so that they can use domestic solar. So he wants to drive electrification of the automotive industry, of the two-wheeler, three-wheeler, four-wheeler market, the taxi market, the bus market, the trains. He talks about electrification of the entire rail network. And so that convergence of transport and energy markets is very much underway. And I think Bloomberg's chart, and I've stolen them for that reason, really highlights this. We look at Australia and say, well, electric vehicles are almost non-existent in Australia. I mean, you can see a Tesla driving around, but in Norway, they are the dominant market. And so these charts I wanted to highlight the red on the bottom, I think really sums it up. When we think about this technology disruption, China is absolutely at the global forefront. And China is a very, very powerful country. It is very, very much embracing industries of the future. And so for Australia, my warning is this technology disruption is global. It's happening faster than we expected, and it will happen no matter what we do. So therefore we should actually look to embrace the opportunities and plan for the downsides of it, because it's going to be driven by mega giant countries like China. And you can see there, China absolutely dominates the two-wheel market, not 40%, 50%, but 99% of the two-wheeler market is electric vehicles in China. The bus market, the easiest market to actually address. And who's done it? It's China. It's not America, it's not Australia, it's not Europe, it's China. And in commercial vehicles, we hear about Tesla all the time. They're the pin-up company in America, but for every Tesla in America, China has 4 times as much penetration and 4 times as much industry development. So electric vehicles certainly compounding the disruption of the stationary power market. Thanks, Stephanie. And just on rate of change, I mean, the IEA has given us some very detailed updates about a month ago on how their energy market outlook has changed. And to me, to say that the IEA concluded that renewable developments would be constrained or retarded by the pandemic, and yet the numbers show exactly the opposite. So what we've seen is that renewable energy is the only sector expected to grow in the energy market globally in 2020. Coal will be down 8%, gas 5%, oil 9%, and total emissions with that down dramatically. So there is profound change, and probably no better market than America. I mean, America, Trump has brought in as a president to bring back coal, or he digs coal, or whatever stupid acronym he came up with, or three-word statement. The reality is the coal market in America is collapsing faster than anywhere else in the world, and coal demand in 2020 is down 25% year to date, year on year. And so that's not a multi-decade change. This is I mean, you extrapolate that, the coal industry will be gone within 3 or 4 years in America. So I'll come back to that. The second subject, and I'll just go through a couple of slides here and then we'll pause for some questions. But the first one I wanted to highlight is that the global financial markets are very much going to play a key role here. So in Australia, we're looking at our federal government, we're looking at the energy policy chaos, and we're very much, I think, disrupted and unable to actually embrace all of the opportunities. My point here is, at the end of the day, it's almost irrelevant. If the government wants to try and hold back a transformation, they will fail. If the tide goes out, as Warren Buffett says, you'll see who's left swimming naked. The financial markets are not ignoring this. And there's probably no better pivot point than in January of 2020, when BlackRock put out a very detailed statement on environmental, social, and governance. And on the back of that, Larry Fink put out his annual letter to all CEOs that BlackRock invests in, namely every CEO in the world. And he made the comment with regard to thermal coal that they would divest all thermal coal mining companies with more than 25% of their revenue derived from thermal coal production. And 2 weeks ago, they put out an announcement confirming that has now been carried out across their debt and equity portfolios for all actively managed funds, namely $1.8 trillion of assets that BlackRock actively manages, and they have now, thermal coal is now divested. Now, if you look at the words that Larry Fink wrote and BlackRock wrote, it was about the economics of it. Sure, there are environmental impacts, there's alignment with the Paris Agreement, but ultimately says this is an economic decision. So the transition is very much underway. It's a fundamental reshaping of finance, and ignore it at your peril. The financial markets certainly won't, and I'll come back to that in a few minutes. But here's a list we've been maintaining for the last 2 years, and this is just a list of the announcements that have happened in the last 2 months. So you might have seen an op-ed that Bob Carr published in The Age 2 weeks ago, and he highlighted just the magnitude of changes in the month of April, and that momentum has continued in May. So we've had 37 globally significant financial institutions announce either new or updated policies effectively divesting from thermal coal. So with 37 announcements year to date, the run rate is almost double the run rate of last year. So we are seeing globally significant banks, globally significant insurers, and increasingly, more recently, globally significant asset managers divesting thermal coal and coal-fired power generation. And one of the points that's really come up in my analysis is, once a financial institution makes a policy statement to move to align with the Paris Agreement, they invariably have to come back to the policy within 12, 18 months, because the policy is in no way aligned with Paris. So they end up coming back, they remove a lot of the loopholes, and they make the policy wider, because their starting point is that they have to align with the Paris Agreement. And to align with the Paris Agreement, thermal coal has to cease to be used globally in OECD markets by 2030 and globally by 2050 at the latest. And so a policy that says you're going to gradually phase out thermal coal over the next 20 or 30 years doesn't comply with the Paris Agreement. And so once they actually start to get to grips with that, they realize the stranded asset risk, they realize they've a fiduciary duty, and they start to accelerate the divestment. And once they've done coal and coal-fired power plants, they then move into infrastructure relating to coal, or they move into divesting from Arctic drilling, deep sea drilling, Canadian tar sands. In other words, they move on to the next most carbon emissions intensive area. And so the momentum is building, the stranded asset risk is real, it's increasing. It's clear that they have not just a fiduciary duty, a moral duty, but they actually have a fiduciary duty not to put their assets at risk, or their trustees for superannuation. They can't put their superannuation monies at risk. So they've got to actually divest for economic reasons, as BlackRock said. And just one chart, I mean, this one is from the IEA, and it highlights the magnitude of change going on in the coal-fired power plant sector. So I said, look, we could wait for the government to move, or we could acknowledge global financial institutions are moving, and those global financial institutions are moving for similar reasons to global corporates. So what we have seen is a relatively rapid exit from the development of new coal-fired power plants globally. And so what we've seen, this is the FIDs according to the IEA, the FID being final investment decision. And so a coal plant gets approvals, 2 years later they get to financial close, and then 3 years later generally the plant would be operationalized. So what we saw in 2019 was only 18 gigawatts of new coal plants globally reached financial close. Now, you have to put that in the context that 35 gigawatts a year of coal plants are being closed because of end of life. And that's coming up with Liddell, it's coming up with almost every Australian coal-fired power plant. It's inevitable they will reach their end of life. You either have to do a multi-$100 million upgrade or you close them. So the point being here that if you're only seeing 18 gigawatts of new coal plants coming into the pipeline in 2019, that is half the rate of closures we saw in 2019. The coal industry is being replaced, and that's happening at an increasing rate. Thanks. Right, we might stop there, Stephanie, shall we? See if there are any questions.
Hi, thanks for that, Tim. There's absolutely fascinating and really compelling numbers in there. We've certainly had a few questions coming in, and I'd like maybe to start. You made the sort of compelling and powerful comments about what's going on in India and China. With the Belt and Road Initiative in China and the amount of investment that's sort of been pushed into fossil fuel generation through that, what do you see as the implications of having to sort of walk back from that in terms of financing over the coming years? I mean, how much of an impact and how slow is that going to be to turn around? Yeah,
thanks, Joe. I mean, it's a very detailed question. China is an enormous country. Every time I look at them, everything is, my China analysts remind me, everything about China is enormous. So there are probably two aspects to what you're saying. Firstly, there's the Belt Road Initiative, which is China outbound investment. And then there's what's happening within China, and the two are absolutely tied together. So if I start by saying, look, if you look in the last 5 years, I think Moody's has put out a number of reports saying probably 90% of all coal plants funded globally in the last 5 years have been funded by China, Japan, and Korea. So you've got export credit agencies in each of those three countries that are involved. One of those at least one of them, export credit agencies are involved in each transaction for a new coal-fired power plant in 90% of the times. Now, once the project is de-risked because the Japanese Bank of International Cooperation comes in and underwrites the project, private banks will come in alongside them. But it's really important to understand when people in the Australian government talk about coal being cheap, what they're ignoring is the fact that almost every coal plant built in the world exists because of cheap subsidised government financing. You can't actually get a lot of finance anymore for a new coal plant without a government subsidy, without government financing. So it's NEXI, it's JBIC, it's JICA, it's the Korean Import-Export Bank But most importantly to your question, it's also the China Import-Export Bank. It's the China Development Bank that is underwriting new coal plants. And that was a core part of the BRI. So what we've seen in the last 2 months is in Korea, the Prime Minister has talked about ceasing all new coal financing by Korean financial institutions. The Japanese government is talking about doing that. We saw JICA last month, the governor of the Japanese Bank of International Cooperation, the #1 financier of coal in the world, say they would no longer finance new coal-fired power plants anywhere. So that was a huge milestone. That just happened last month. But coming back to your question, China is still willing and able to fund coal. And that is the elephant in the room, if you like. So I've been watching the BRI. China, about 3 years ago, started to get a lot of flack for their Belt Road Initiative. It's all very well working with Bangladesh and Pakistan and Egypt and so on, but it was very fossil fuel intensive. It was about exporting surplus capacity in China that was no longer needed. And so to me, the Belt Road Initiative was somewhat, well, not somewhat, it was entirely self-serving, as most foreign aid is, unfortunately. And so they were pushing coal plant developments onto countries like Egypt. Now, a month ago, Egypt actually cancelled a 6.6 gigawatt coal-fired power plant development that the Chinese were funding, building, and operating. And they said, we can't afford it. We actually want something that's a third of the size, and we want it renewable, and we want it domestic Egyptian wind and solar. And China came in and said, fine, we can do that as well. So we are starting to see something of a greening of the BRI. But in the last 2 years, China has had huge issues with the American trade war and then with the pandemic. So I think China's focus has gone very much inward about protecting the domestic economy. And I'd have to say the Chinese have been alarmed at the deterioration in the rate of growth in China. And so they have done a lot of pump priming. And unfortunately, when you pump prime, you do construction. That's how the Chinese generally respond. You build more bridges, more roads, more coal plants, and that's how they are responding. So China is in an unusual place, and it'll be interesting to see where the next 5-year plan comes out. But China, like any country, is looking after #1.
Fantastic insight. Thanks for sharing that, Tim. And if we bring it to a more of a, I guess, a domestic focus, your segue onto sort of the government perspective actually opens up a question from Lee, which talking about the coalition's basically saying that we're on track to meet the carbon reduction target, whereas you'd struggle to find energy experts or anyone not in the coalition that thinks this is the case. What do you think is really going on there, Tim?
Yeah, and I might come back to Australia in a bit more detail, but I was listening to Angus Taylor talk a week ago, and he made the comment, "Oh, we want to develop industries." I think the phrase he used is unfortunately using the Tony Abbott 3-word phrases. So it was technology, not taxes, was his response. We're technology agnostic, but we don't want to tax. We don't want a carbon tax. But what he then went on to say was, we are willing to subsidize polluters. And so I look at that and go, that's an entirely unsustainable proposition. He doesn't want to tax anyone. He doesn't want to tax the polluters. He wants to subsidize them. So really what he's saying is that you and I should pay our taxes to subsidize the polluters. Now, I come from a free market background. I come from a financial market background. The market is the best solution. We need the government to set the framework, and the best framework, as I think every economist, or almost the vast majority of economists and the vast majority of people in the market say, a price on carbon would then drive companies, industries, and money to driving us the cheapest and most effective solution. So unfortunately, the technology not taxes slogan is yet another slogan from a government that is still very much wedded to fossil fuels. And unfortunately, if you look at the balance of payments in Australia, we exported $120 billion of fossil fuels last year. Unfortunately, $120 billion of reasons every year to go slow. And so a lot of my work is looking at countries like Korea, Japan, China, and India that are on the other side of that, they're importing our fossil fuels and they're trying to move as fast as they can. So my point would be the customer is going to be proven right, and we can acknowledge that and embrace the opportunity, or we can try and prop up the industries that have been critically important in the past, but in doing so, we're missing the next opportunities. And to me, the next opportunities are enormous, as Dr. Finkel talks about.
And I guess the sort of the knock on there when you're talking about policy and technology, when you're looking at the push for gas, impact of the collapsing international prices there as well. How would you see that playing out?
Yeah, I was very disappointed by the COVID gas committee. I think they labelled it a manufacturing roadmap, but it was really just the COVID gas committee roadmap. It was the roadmap to providing massive taxpayer capital subsidies, a $6 billion subsidy for a pipeline that I think had already been evaluated as non-economic. And they wanted to put $6 billion of our money into a capital subsidy to help prop up the gas industry. They also wanted a $6 floor price propped up by the Australian government to a floor price on gas. Well, hang on, we want to actually drive prices down in energy. We want to drive decarbonisation to build industries of the future. The idea we're going to throw subsidies at the gas industry in order to help the rest of us, I think unfortunately it's the incumbent industry having way too much power politically in our country, and we need to actually try and let's go with a technology neutral outcome, or let's actually go with a positive strategy to embrace the opportunities. And that means embracing the technologies that are going to win this race rather than prop up industries of the past. I don't see gas as a transition fuel, and I'll come back to a chart to explain that in a minute.
Maybe one final question for this this segment, Tim. The really sort of interesting one from a technology perspective as well, when you switch to transportation, is, and this question came from Matt, what defines the tipping point on transition to electric vehicles?
Yeah, and that's why those Bloomberg New Energy charts are really important. If we looked at a tipping point as, I've heard numbers as low as 2 or 3% penetration, but that's a global figure. The penetration in Norway is 50%. The penetration in China is 6 or 7 or 8%. So they're already through the tipping point. And in fact, I think and Bloomberg New Energy has made this point repeatedly, we peaked the internal combustion engine probably 2 years ago. We peaked in thermal coal use in the power sector 2 years ago. We peaked thermal coal use globally 6 years ago. We're already through the tipping point. And that's where you need to look at things like the development and the buy-in of industries and finance. And so that then snowballs. So I would argue we're actually really close to the tipping point, if not already through them in many cases, when you look at particular markets. And it's only going one way. So let's embrace the opportunity rather than debate whether or not it'll happen.
Great, thanks for that, Tim. Maybe we'll go back into another sort of segment of the presentation. There's more coming in as well.
Yeah.
So we'll keep an eye on those, and we'll have probably about 10 minutes then to run through the remaining ones.
Mm-hmm.
Okay, thanks. So section 4, looking at the global equity market response. I just wanted to highlight, it's not me putting forward hypothesis. So if we the IT is working again. You'll have the copy of these slides. You can look at them in detail. But this slide is just looking at how the financial markets have tracked two companies over a 2-year time frame. And the green company is NextEra Energy. Now, NextEra Energy is the biggest investor in renewables in the world. It's also the most successful utility in America. It's also the largest utility in America, and it's in fact the biggest investor in infrastructure in America as we speak. And the red is Exxon, the biggest oil and gas company. And so, and the purple is the US stock market, the S&P 500. So I just wanted to highlight the financial markets are massively differentiating between Exxon and NextEra. NextEra does not spend a cent on coal. They're not spending a cent on new coal or new nuclear, and they highlight gas is next, that they are investing massively in batteries as a replacement over the medium to long term for gas peakers. So that's how the CEO of NextEra talks, whereas Exxon goes, no, we don't accept the science of climate climate change. We don't actually think the markets are going to transition. We keep investing $30 billion a year in new fossil fuel projects that the world can't afford to use. And the stock market is telling you that is not a winning strategy. Thanks, Stephanie. This one, Peabody Energy. You might be aware Peabody Energy went bankrupt in 2016. It phoenixed in 2017, shrugged off all its liabilities and relisted. And this is a 2-year view of Peabody Energy in red. It's down 90% in the last 2 years. That is financial distress. So in a market where the stock market is actually up, bizarrely, even with this global pandemic, over a 2-year time frame, Peabody Energy has massively, massively underperformed. So if we go back to BlackRock's statement, we're divesting coal, well, they didn't divest fast enough. They've, in fact, BlackRock, up until this year, was the biggest shareholder in Peabody Energy. And the chart on the left just shows the massive accelerating decline in coal in America. It's bizarre, the EIA thinks there's going to be some bounce back. Now, investors aren't telling you that. They're not investing a single dollar in a new coal-fired power plant in America anywhere, and yet the EIA has the same problem we have, that it's a government body and it believes the government viewpoint that climate change is not important and that the world won't adopt. Well, industry and finance are telling you they will, so that forecast will be proven totally wrong for 2021, in my view. Thanks, Stephanie. This is probably my favorite chart. Ørsted is the world's largest investor in offshore oil and gas, offshore wind. It was Denmark's oil and gas company. It changed its name from the oil and gas company of Denmark, Dong Energy, to Ørsted 4 years ago, and it divested or closed all its oil and gas businesses, and the stock market loves them. They're the blue. The red is BP. BP has been a serial underperformer for a decade. In the last 2 years, the underperformance has been even more pronounced. And so it's not surprising to me the new CEO has announced a new strategy, which is to pivot into renewables. In other words, to copy the strategy of Ørsted and do the right thing by his shareholders. And oh, by the way, that also does the right thing by the planet. Thanks, Stephanie. And going back to Joe's question, gas is not a transition fuel. Maybe 10 years ago it was, it could have been, but the idea of building new gas plants and new gas pipelines today means they're going to be around for 40 or 50 years. The financial markets are telling you that is not how they see the world. And I think we saw that on Q&A last week when we had the responsible investors. Zoe Witten was saying, well, investors are all asking, is gas a transition fuel? And they're increasingly voting with their feet. They've already answered that. So this chart is Chesapeake Energy. It's a US-centric chart, obviously, but Chesapeake was the biggest independent developer of fracking. It's the founder of fracking in America. It has transformed the American energy markets, and it's destroyed huge amounts of wealth. It peaked at a market cap of $37 billion, and it's now in bankruptcy. Okay, I think they're about to file for Chapter 11, but anyway, the share market's telling you it's down 99%. And so that's what the market's telling you. So again, when BlackRock says they're moving, they're not divesting for moral reasons. BlackRock said they're not a moral fiduciary. They are doing it for economics. Thanks. And just to finish up on a few slides on Australia, the first one, I mean, Australia's energy market, I mean, it's unusual. We've had a decade of policy chaos from our federal government, and yet at the same time, the markets are fundamentally changing anyway. So I've stolen this from OpenNEM, Simon Holmescourt's chart, and it just highlights that every time you build a wind farm in Australia, you close a coal plant. Every time you build a solar project, you close a coal plant. Why? Because energy efficiency is driving overall decoupling of energy demand from economic activity. And so the market's shrinking marginally thanks to energy efficiency. And so as we add new low-cost generation that is zero emissions, it squeezes out coal. That is the inevitable outcome. Thanks. The Reserve Bank chart just highlighting the reason, again, economics, standalone cost of wind and solar, whether you like them or hate them, they are the low-cost supplier. And so unless you have a government policy to stop them, oh, that's right, we do have that, they're going to happen anyway because they are the best market solution. They are dramatically cheaper. Now, obviously the price, the wholesale price of electricity since the Reserve Bank put this chart out 2 or 3 months ago has dropped dramatically. That is the inevitable outcome. Deflation will drive down the wholesale price. Now, we can talk about grid firming in a sec, but that is the outcome. We are going to see investors willing to invest in the low-cost solutions or not invest at all. They'll go offshore if they can't invest sensibly in Australia. Thanks. Just in terms of time, I'll go through this very, very quickly. The chart on the right is from Woodside Energy. So Woodside Energy announced that they were putting on hold $53 billion of CapEx in March of this year. 1 month later, a majority of shareholders said voted that they wanted Woodside to have a climate policy. Now, Woodside, they got to 50%. Unfortunately, Woodside's chairman said, no, you need 75%. We're not going to adopt the policy. We're going to ignore what our shareholders want, and we'll do what we think's best. And what we think is best is investing in more fossil fuels that the world can't afford to use. So refusing to have a transition plan is not a winning strategy, is what I'm trying to highlight here. The stock market doesn't like it, and their CapEx plans have been slashed. Might go to the next slide. Second last one. Renewable energy. We've just put out a report today looking at aluminium smelting. And I mean, if you'd asked me 5 years ago, what was the outcome for aluminium in Australia? We have very high electricity prices. We have the most emissions intensive grid, one of the most emissions intensive grids in the world. Aluminium is just solidified energy, solidified electricity. And Rio has made the point, if Australia remains a high emissions country and a high electricity cost country, they will have no choice but to close the operation. So we've looked at the technology, we've looked at the opportunities to both decarbonise and drive down the price of electricity, and embracing opportunities, having the right price signal and the right framework could actually allow Australia to be a world-class player in aluminium with low-cost electricity, zero emissions electricity, and in fact where Tomago and Portland and Gladstone all play a key role in the form of demand response management in helping stabilise a grid that has ever higher penetration of variable, intermittent, but very low cost renewable energy. And final one, just to deal with grid firming as a question. I'm very much an analyst, a finance analyst, not an engineer, but one of the points that when Angus Taylor talks about a gas-led recovery, and when Prime Minister Scott Morrison talks about a gas-led recovery, he's ignoring the integrated system plan of AEMO, which says gas will have almost no relevance in the electricity market under any scenario over the next 20 years. It's just simply too expensive. And there are better technologies that are cheaper. So that's the integrated system plan. I've stolen that from Ketan Joshi's excellent report from Renew Economy last week. So have a read of his write-up. But now I'm not saying it's irrelevant. It actually plays a key role, but it's a very specific peaking power role. And that is it has 100% firming reliability. So you run a peaking gas plant 10% of the time. So it's probably 10% of your capacity, but only 1% of your generation. But it's a critical 1% in a low emissions, intermittent renewable energy market. What I think will be even more important is green hydrogen, renewable energy hydrogen. I call it power to X because although it's easy to talk about green hydrogen or renewable hydrogen, we're actually talking about using renewable energy in the ammonia or ammonium nitrate or aluminium or hydrogen. In other words, it's X, where X is a chemical process or a processed product like aluminium or green hydrogen, because it's actually very hard to export hydrogen, but it'd be very, very easy, and in fact is hugely traded already, ammonia. And Australia is a world player in ammonia for fertiliser production and explosives. We should be decarbonising the ammonia production onshore as the first step to build scale, to build learning by doing, and by embracing the technology opportunities. And although you probably hear a lot about Australia and Dr. Finkel, particularly the hydrogen roadmap is absolutely key for Australia. Fortunately, Angus Taylor has bought into the importance of that hydrogen roadmap. I think every state energy minister talks about it. They're all competing, but it is a race, and it's a global race. It's not an Australian race. Korea is talking about it. Japan is talking about it. China is talking about it. Russia is talking about it. Germany is talking about it. And you can see investment dollars are flowing dramatically as the scale goes up, and we learn by doing. And that actually becomes, to me, the key enabler. As Ross Garnaut and Dr. Finkel have said, we could build massive overcapacity in wind and solar, and then we just use electrolysis to convert the surplus electricity at record low prices into hydrogen. It can then be used to run hydrogen gas turbines, to run the grid, or it can be burned in industrial processes, and that helps decarbonize hard to decarbonize manufacturing industries. So that is the opportunity. We need to embrace it. Thank you.
Thank you very much, Tim. We're going to go back to the Q&A now for the group. I'll hand it over to Joe.
Yeah, thanks again so much for that, Tim. I think some continuing fantastic insights there. When we touched on the integrated systems plan, it flagged up another question that had come up a little earlier from Jasper about the technology cost assumptions that had gone in nominal terms, suggesting there was barely any reduction in solar and wind costs between 2022 and 2030. Anything you can comment on around that?
Yeah, probably I would start by, I follow what China is doing because they are the world leader in this space, whether it's solar, wind, batteries, automotives, everything. They're the world leader. They've embraced the opportunities before investment, for jobs, for technology reasons, for export reasons. So they've started this year announcing a dramatic expansion in capacity of solar wafer manufacturing, solar polysilicon manufacturing capacity, solar cell manufacturing capacity, solar module capacity. And so when a year or 2 or 5 years ago, they were building 1 gigawatt factories, now they're building 5 or 10 gigawatt factories. So they have they've actually announced 500 gigawatts of capacity expansions in the first 3 months of 2020, which is double the amount of capacity expansions they announced in the whole of last year in total. Now, when you talk about, well, I mentioned 500, it's actually polysilicon, cell, wafer, and module. So you've got to divide it by 4 to look at how much end modules come out. But last year, the world installed 100 gigawatts of solar globally, and they've effectively announced a more than doubling of global capacity in just 3 months. So the idea that prices aren't going to drop dramatically, well, either installs will double or prices will drop, or in fact what will happen is both, because prices will drop as we've just seen, and that'll drive demand uptake. So I think the idea in the last 6 months, 12 months, remember, if you look at Australian prices of solar, in the last 12 months, they've actually gone up a bit. Why? Because the risk has gone up because of the policy chaos, because of the MLF debacles, because of the grid integration issues. And remember, we import almost all of our modules, so the Aussie dollar dropping 20% pushes the price of solar up. So at the end of the day, as risk has come into policy frameworks, the cost of solar has gone up, but that will go out of it.
And this gets the crux of some of the issues around the IEA forecasting and things as well, doesn't it, Tim? Is this or scenario planning, as they would term it? It's a lack of appreciation of falling costs over time, which is effectively what the point you're making there.
Yeah, I would argue ultimately the IEA is funded by the OECD and the fossil fuel industry. I would love to see the IEA's balance sheet and funding profile. We've put that question to them. They've refused to answer it, and they've refused to answer for very good reason. I'd say half their funding comes from fossil fuel companies, and that's my supposition. It's an informed guess, but we don't know because they have zero transparency. But ultimately, if you work for BP, you'll probably come up with a scenario aligned with BP's interests. It's very hard to get away from groupthink and captured thinking. And that's unfortunately why we have a political debacle in Canberra, because the groupthink and the regulatory capture is a key issue, in my view, in the IEA and in Australian politics. Now, the good news, and I've just sledged our government, the state governments in Australia, I think, are far more actively embracing the opportunity. They're realizing they're the ones who actually ultimately have the authority on energy markets. And so they're just moving forward. And it's great to see both sides of politics are embracing it. So it just seems to be a Canberra versus the states fight. And the good news is we've got a gigawatt wind farm in Queensland. We've got a 400 megawatt solar project in Queensland. We've got New South Wales embracing the importance of interstate grid connectivity. We've got Tasmania announcing a 200% renewables target and green hydrogen. So we've got the states really moving, and it's the Liberals and the Labor side of politics. That's the good news. Unfortunately, the federal government plays a key role in making sure it's a least cost transition. Well, they should.
Touching on the other technologies, I guess the conversation wouldn't be complete without the question around nuclear, which is raised by Glenn. Looking at China being back into nuclear now, the SMR, small modular reactor research. What's your view on that sort of 2030 to 2040 time scale, with MIT suggesting that both renewables and solar deliver the lowest cost of decarbonisation?
Yeah, if we're talking Australia, and I know the question is international, so China is definitely going all technologies. They are the biggest builder of hydro in the world, they're the biggest builder of nuclear in the world, they're the biggest builder of renewables, and unfortunately they're the biggest still builder of coal in the world. But if Australia, if we were to commit to building a nuclear power plant, let's call it in 2 years' time. Why? Because we've actually got a moratorium. It's illegal to build a nuclear power plant in Australia. So we'd need a change of government act. Once you did that, you then have to go to an international tender. The only players who actually have nuclear technology are the Russians or the Chinese. So I think Australia would probably have a little bit of a problem of inviting the Chinese to come and build a nuclear power plant in Australia. But you might think, oh, what about Westinghouse in America? Westinghouse went bankrupt. It then got bailed out by Toshiba of Japan, and Toshiba almost went bankrupt thanks to Westinghouse. So if you look at the financial market response, the financial market won't fund new nuclear power plants. The only people big enough to fund nuclear, I mean, we're talking a $20 billion investment in one plant. It would take 20 years to build. It's illegal anyway. And we have none of the expertise, none of the engineering capacity, none of the financial capacity, and none of the technology. So to me, it's a total red herring. It won't happen in Australia. You look at Hinkley Point, it's 3 times the cost of renewables in Australia. Why would we want to go and spend $20 billion of taxpayer subsidies to an industry that's really expensive and really slow? Now, that's an Australian response. America, Germany, China have nuclear. I think Michael Liebrecht's answered that question very, very categorically. If we're to deal with the climate crisis, we need to use every tool available. And I think that's the gist of the question. If we have nuclear plants in operation today in America, we should extend their life so long as it's safe.